the March Madness started last week. It was quite the maddening start to the week and to the end of the week in the markets. Basketball was great, but the markets were quite mad.
Yeah.
A lot happened last week. We're going to go through a lot of the headlines that we've seen regarding the banks, et cetera. But I think first we want to look at returns because there was quite a bit of volatility during the week, spike from some of these bank failure issues. And let's talk through the returns, first starting with equity.
And if you look at just large cap stocks in the U.S., the S&P 500 up 1.47%, but under the surface, it really mattered. Style mattered, sectors mattered, et cetera. So you saw large growth stocks up over 4%, a very solid week. Value stocks down over 1.5%. And basically the difference there in returns between growth and value, one comes from financials. Value indices have much more exposure to financials, much more exposure to banks. That was the hardest hit area of the market. Then next up would be energy.
Yeah, energy.
Much more value oriented. And then some of the tech names, Apple, Alphabet, Meta, which are all in the growth index, did reasonably well. So quite a big divergence. And then you also see in other areas of the U.S. equity market, small value down over 10% month to date. That's where a lot of the regional banks are that are dealing with deposit migration and fears of, going the way of Silicon Valley and Signature.
Yeah.
So.
Conversely, the fixed income market benefited from all this volatility.
Yeah. Bond yields, treasury yields across the curve down month to date and last week. We definitely had a steepener of the yield curve. And how that basically worked out was the 2-year yield went down a lot and the 10-year yield went down a lot, but not as much as the 2-year. So we went from having a 1% inverted 10-2 spread to now having a 0.5% inverted 10-2 spread. So interesting because that's some of the fastest steepening in the yield curve we've ever seen outside of a recession. But we're also still have one of the most inverted yield curves we've ever seen outside of a recession. So
yeah, and I guess
talk about maddening, right?
Is there any thing to read into the fact that the curve has been inverted for such a long period of time?
Well, you should ask Silicon Valley Bank or Signature or any bank right now that's going through this situation where, if they have uninsured deposits, for example, and they need to keep them at the bank, they need to entice those depositors with really attractive market rates. Short-term rates are high, so you have to pay up, right? And if your cost of capital goes way up just to compete, to offer attractive deposit rates, and then you go and make a loan for not very attractive interest rate, well, you just lost money.
Yeah.
So you become a loss-making machine.
I think it's worth mentioning, sort of explain to the viewers, the banks were not offering very good rates at all on your overnight cash.
Yeah.
Versus a money market where you're getting close to 5%.
Right.
So just explain that so the viewers understand.
Yeah, and a lot of the large GSIBs, the global systemically important banks, still are not offering great deposit rates. Why? Because they have no need to attract deposits. Right. Deposits are knocking down their door. They do not need to raise deposit rates to lure them in. If anything, they could stand to lose some deposits, the large banks. So you have that segment of the banking industry that has absolutely no incentive right now to offer you an attractive deposit rate. And then you have the rest of the banking community, much smaller than that, who, anybody who has a deposit there is like, what am I doing here? You need to offer me a nice, attractive deposit rate, or else I'm taking my money and I'm going to Bank of America or JP Morgan or something else like that. So there's tremendous bifurcation now due to all this deposit migration caused by these bank failures.
Okay, and we'll get into that in a little bit more detail here, but let's first take a peek at the alt bucket for the week.
And in commodities, for example, you see energy down significantly with precious metals up. And that's classic recessionary fear type trading in the commodity space. Energy is one of the ones that gets hit first. And what do? You buy silver and gold.
Yeah.
And so that's basically what's happened here month to date.
So we've got energy recession type behavior or activity in the energy markets. We've got banking crises, but the consumer is still doing well and growth is still coming in better than expectations.
Yeah.
Like, where are we in the economic landscape here? This is a point of oddity, because usually by now we're seeing all the signs of recession.
Yes.
Or potential recession.
Yes. Are you basically in the eye of the storm, the calm before the storm? It's very difficult. I mean, I cannot remember a time, my career is obviously shorter than yours, where there have been so many conflicting factors. You know, if we look at our recession indicator and we take each one of the underlying indicators and we trace its normal path around recession, half of them are accelerating as if the recession has already started, and the other half are saying there's nothing on the horizon. Yeah. So it's very difficult time.
And so clearly the Fed is hiking to a point where they're breaking stuff.
Yes.
And this week the Fed's going to come out. We're anticipating still that they will hike based on our views here, but anything could happen right now.
Right.
And the market has been all over the place in terms of where the Fed funds rate is going to end up throughout the course of the remainder of this year. So we had more changes to it again last week. So take us through the change.
Yeah, and that red line, just as a reminder, is what the market was betting the path of the Fed funds rate was going to be if you asked the market on February 28th. They would say, well, it'll sort of progress like this. The Fed is going to hike to, something around 5.4% in August, and then cuts all the way through, 2024, and then hiking after that. And that was because inflation was the primary fear. Need to defeat inflation. That's what the red line was hopefully enough to do. If the Fed raised in line with the red line, hopefully we'd defeat inflation and we'd be all good. And then the difference between the red line and the blue line is everything that's happened in March, which is, as you said, the whole hiking until stuff starts breaking, and stuff is breaking. So now the idea is that over the meeting this week and the meeting in early May, 25 basis points total of hikes. So either they take a pause now and hike in May, or they hike now, don't do anything in May, followed by aggressive rate cuts.
Yeah.
Getting down below 3% on the Fed funds rate.
Just sort of the logic of that. Did you talk about why would you even be thinking about rate hikes if you're going to aggressively cut rates? Like, what's the Fed thinking at this moment in terms of, well, we broke some stuff, but we fixed it pretty easily.
Yeah.
I mean, quickly and easily, and we're negotiating ways to continue to support the banking system.
Right. So it's a very difficult time because there's a level at which they need to get the Fed funds rate to defeat inflation, and they're not there. Right. So they have to do hiking. That's part of their mandate is inflation. Price stability, that's everything they've said. And all the economic data suggests they still have plenty more work to do there. And then there's this theoretical level of the Fed funds rate that we need to stay below, or else we're going to have financial instability. And we're there. So this is the hard part, right? All the rate hikes up until now were easy. Now, you really have to make a decision. Am I breaking stuff to the point that it's going to create a recession, which will then defeat inflation? And they would probably say, no. We're not, because we solved the banking problem, right? We have the Bank Term Funding Program, and the FDIC is taking care of Signature and Silicon Valley, et cetera. So like you were saying, when we go to the meeting this week, there are legitimate arguments for a hike, nothing, or a cut. Cannot remember the last Fed funds meeting that we went into where there's a legitimate argument for any one of those things.
Right.
Yeah.
So let's move to a new chart we have in here, lender of last resort, and talk about what actually happened last week when the Fed sort of came to the rescue of these banks.
Yeah, what you saw, so if you watch every week, the Fed releases data on their balance sheet, the level of reserves, et cetera. And what we saw last week was, week over week, about $300 billion worth of new loans were issued. That's the green line. You can see that basically spikes during times of stress. Spikes during COVID, and it spiked during 2008. And this was primarily two things. discount window lending, which you would expect. That was about half of it. And the other half was lending by the Fed to the FDIC bridge banks established for Signature and Silicon Valley. So those are temporary things. Banks don't want to have discount window loans hanging out for too long. And the FDIC bridge banks are temporary vehicles, right? But in terms of just the Fed's balance sheet, that has the effect, if you look at the purple line, it goes straight up. Yeah. I mean, it has the effect of undoing half of the tightening since March 2022 in 1 week. If you're just looking at total assets, you say, well, the Fed's been reducing the size of their balance sheet by $95 billion per month. That's quantitative tightening. This banking crisis and the banks seeking out new liquidity and getting it has undone half of that aggregate tightening that the Fed has been working on for quite some time now, right?
Yeah, and how should, it's a little different than typical ways to sort of solve this problem. This money isn't going out into the economy.
Right. That's why you do have to look at it different, right? So when you look at the Fed's balance sheet, there are generally two types of assets. There are securities, and then there are loans. Right. These are loans during a time of stress. Like, banks aren't going to be taking this and then creating money with them, versus securities, when the Fed is increasing their securities portfolio, that pumps the banking system full of reserves, and it leads to money creation and so on and so forth. So this is temporary to plug a hole type money. Right. Which we don't think will have the same sort of net liquidity impact as if the Fed were to say, hey, we're done here, we're done hiking, we're done with quantitative tightening, we're adding to our balance sheet, we're cutting the Fed funds rate. That is the true liquidity that you're waiting for if you're hoping on an equity rally.
So said a little more simply, this shouldn't impact asset prices to the upside. This should just be a non-factor.
Yes.
And potentially cause more concern than it is good, because if they've done this, what else do they see in the banking system that might warrant them having this facility open? So
right,
remains to be seen.
And one other thing to add is, this goes back to the fact that the Fed could do anything this week, but we think odds are they're going to hike, because the hike is symbolic. It's absolutely symbolic. I mean, bank reserves last week increased by $440 billion. That undoes half of the tightening since the first rate hike in March 2022. All of those rate hikes drain reserves from the system. And then in 1 week, half of them go away. So if you want to hike next week, Fed, you just go for it. It doesn't matter. The banks are going to increase the reserves as much as they basically need.
Right. Yeah. Exactly.
It would be largely symbolic, and you as the Fed could say, look, I'm being hard on inflation.
Which is still a serious problem, because our inflation forecast actually ticked up. The inflation data last week for core ticked up.
Right.
So inflation's not something that they've defeated.
Exactly.
Just to reference the net liquidity chart and the tick up here at the bottom, you want to go through and explain.
Yeah, that net liquidity number, it starts with Fed assets. Fed assets went up. Why? Because of the loans. So, we're going to be tracking this because typically when we look at net liquidity, it's allows us to create a liquidity fair value for the S&P 500. We would take this boost in net liquidity thus far with a grain of salt, because it's just adding to temporary loans. And add the Fed H4.1 release to the slew of new data releases you need to watch for every week, because we're going to be watching it very, very closely to see how much banks are using these facilities and what impact it ultimately has on liquidity. So,
and maybe before we pivot, for lack of a better term, off of the Fed here, what is the usefulness of putting time and space between a hiking cycle and a cutting cycle? Like, what traditionally triggers the time between those?
That's a good question. Traditionally, there isn't a whole lot of time between them.
Because they overhike. Usually they overhike into these things. They're too late, right?
Usually it's sort of a stair step up and then an elevator down.
Yeah.
So the time in between them is usually just how long does it take for the rate hikes to manifest themselves in an actual tangible economic recession when looking at the coincident economic data, which can take a little while.
Yeah. So let's say hypothetically they have overhiked already, and this is it. Like this, they do this 25 basis point hike, or they don't do it. And next meeting in May, they start cutting.
Yeah.
What does that do to inflation?
Well, I mean, you can definitely go back to the 1970s. It was a little different back then, right? Back then, the Fed needed to hike more to defeat inflation, but ultimately stopped due to political influences because we didn't want to increase unemployment. And, basically the government was undermining their credibility. But now it could totally happen where the Fed doesn't hike as much as they need to because of financial instability. And ultimately, financial instability undermines their ability to do what they need to. And what happened in the 70s? Well, they had to do 3 hiking cycles, and it was awful.
Yeah.
And then finally, Volcker came in and did what had to be done in the 80s, and that was it. So
it seems like Powell understands that, at least from what he says, he understands that. So I wouldn't be surprised if he just kept the foot on the gas here and kept hiking.
Agreed. And then precedent last week, the ECB hiked 0.5%, even with everything going on with Credit Suisse. So that definitely matters.
Great point. So let's move on to inflation and our updated forecast. As I mentioned, it did tick up on the core side last week on the data. Maybe just go through what triggered that and why our forecast still is for 5% inflation.
Yeah, I mean, on the core side, inflation that started off in the goods sector of the economy has gone into services. Mm-hmm. No doubt about it. Services and housing and shelter. And the problem with it getting into services is in order to provide services in the economy, it's very labor intensive. And so that's sort of the mechanism to go into a classic wage price spiral. That's why the Fed wanted to keep the inflation out of the services sector. Mm-hmm. But it's clearly out of the bag. And so now you look at our forecast, the dark blue line, we're showing almost no progress in core inflation through the end of the year. I mean, we're at 5.5% now. We were 5.5% in January year over year. We're looking at maybe 5% by the end of the year. This is exactly what we mean. Now the Fed's job gets really hard.
Yeah.
You're breaking stuff, and inflation is just slapping you in the face and saying good luck.
And 5% is a very high inflation rate.
Yeah, 5% from here.
From here.
Yeah.
Right.
So
tough.
Yeah. Tough job.
Things are already expensive. Just try to get a hotel room or a flight.
Yeah.
On the economic growth side, things just keep surprising to the upside, right?
Mm-hmm. Mm-hmm. And it's been spending. I mean, you look at the economic surprise, those green bars. Year to date, expectations for economic growth were low, and the data's beating. Yeah. And if you look at like Atlanta Fed GDP now for Q1, right now it's tracking over 3%, slightly over 3%, which could be off at this point by plus or minus 1.5%, but still.
Still, we were thinking maybe closer to 0.
And if you look at the underlying components, it's just been consumption. It's been good spending, services spending, better than expected. And as we've said in prior videos, if consumers right now are going to go out and spend, they're going to take future consumption and bring it into the present when inflation is high. That means they're exhausting their excess savings accumulated during the pandemic quicker than they otherwise would. Mm-hmm. So you could look at this and say, oh, there's so much momentum. We view it more as there's an expiration date on the savings, and that expiration date got closer to today. Because spending was so robust during Q1. So maybe those excess savings now run out in July or August as opposed to September, October, which what we were estimating coming into the year.
Okay.
Yeah.
All right, and then finally, recession update. Still elevated?
Still elevated. The recession always seems to be 6 months away, right?
It does.
Still low probability. We're in recession right now. I mean, if you look at the underlying indicators here on the next chart, that whole middle section, that medium term, which is right around the 6-month time period, those are all red. Yeah. They're all ugly. A lot of them have even progressed faster than they normally do heading into a recession. But you still look at anything that has the labor market baked into it. SOM, Piger, nothing. And then now we've had WTI crude oil come down a lot, which is great. So that's actually slightly reduced our longer term recession probability. So still elevated, and then any little weakness in the labor market could spike the probability quite a bit.
Yeah.
So.
All right. Before we sign off, over the weekend, Credit Suisse and UBS did a deal that was orchestrated by the Fed and other central banks.
An arranged marriage of sorts.
Let's just make a few comments on that and our take on it.
Yeah. It actually turns out, so last week Credit Suisse got 50 billion Swiss francs worth of liquidity from the Swiss National Bank. Everyone thought that may temporarily, alleviate any concerns, but in actuality there were stipulations with taking that money, and the stipulation was this is temporary and we're going to broker a sale. So Swiss National Bank, the Swiss government brokered a buyout of Credit Suisse by UBS, literally like cross the street, bitter rivals. And UBS was able to buy a global systemically important bank that previously had over 500 billion US dollars worth of assets for the grand total of 3 billion Swiss francs. And then they also got a lot of sweeteners. They got 100 billion Swiss francs of a liquidity backstop in case they run into any issues, assuming Credit Suisse's operations. And they also got a $9 billion Swiss franc backstop on any potential losses. So it sort of smells of Bear Stearns.
Yeah.
Right?
Yep.
Sort of the JP Morgan Bear Stearns combination.
But far less chaos created from it, right? I mean, Bear Stearns was a nightmare. This seemed to be very... they had a blueprint from before, probably, that they just followed. And what is the potential for this to be happening with other banks?
Yeah.
Or insurers, potentially?
I mean, there's definitely potential, right? It's so hard to predict exactly how this just a one-off thing. Credit Suisse had its own troubles, obviously, like a lot of idiosyncratic issues, but ultimately they lost confidence in the bank, and depositors and clients were pulling money out like crazy. And we've seen how it can spread in the US. I mean, once confidence in the banking system is broken, it usually doesn't just stop with one bank. Mm-hmm. So we're not going to sit here and say that's it. Okay, the European banking system, commercial banking system is all good because of this deal. Unfortunately, we'll just have to see how it plays out.
Yeah. Well, it's been an interesting week. This week is already starting interesting. It'll probably be more interesting as we go through it. So we'll be back next week to talk about the Fed meeting and hopefully some good news on the equity return side. Till then, let us know if you have questions, and we'll see you next week.